Hello and welcome to our webinar about trade war impacts on the supply chain. My name is Danielle Roberts, and I am joined here with Mike Baudendistel and Zach Strickland, who are going to be discussing the current condition of tariffs and what does this mean for freight going forward. And with that, I will turn it over to you.
Great. Well, I'll start. Mike Baudendistel here of Intermodal, and I'll start by going through kind of the latest on the tariffs. And this might be obsolete and out of date by this time tomorrow or this time this afternoon, but I'll go through what you know now. So we all woke up Monday morning or late Sunday night, depending on how late you stay up, to the new agreement where China and U.S. agreed to suspend most tariffs for 90 days. They're going to lower the, quote, reciprocal tariffs on Chinese goods to 10% from 145%. And then similarly, China's going to lower tariffs on U.S. goods to 10% from 125%. So we have this sort of 90-day reprieve, also going to cancel other retaliatory measures, things like restrictions on critical minerals out of China. And so those things change, but there is still the separate 20% tariff that President Trump imposed on what it believes China's role in fentanyl is. That's going to remain. And then the tariffs that predate Trump's second term it's 10%. So in total, you have about a 30% tariff on Chinese goods for the next 90 days. Saw that Citi estimated that it's more like 39. They must have a more sophisticated way to estimate that, but in sort of that range. Also did have a Treasury Secretary said that he would meet again with Chinese officials in the next few weeks on a bigger agreement. Don't have any idea what that means. Apparently during the discussions over the weekend, there was a very long and in-depth sidebar on fentanyl, and also a lot of discussion on intellectual property and respecting U.S. trade secrets. So those do, speculation of what actually the motive was. It does seem like some of those things actually were the motive, at least based on what how the time was allocated over the weekend. I think the idea is to establish clear guidelines to enable commerce, not shut off commerce, while also respecting U.S. IP. The other thing that happened, not on Monday, but this morning, I saw it, which is also very impactful, is the change to the de minimis. Now, the de minimis exemption, that's the exemption that a less than $800 item is not subject to tariffs. This was something that was kind of abused. It had grown tremendously. It's the e-commerce volume. That was cut off from China in early May. It's going to be cut off from the rest of the world as soon as there is sufficient sort of resources in place to handle collecting, tariffs. But today they cut the rate on those goods that would previously qualify for the de minimis from the 120% tariff to a 54% tariff. So that's where we are on small package items, 54% tariff on those things less than $800. And then on the postal side of things, what they had said before today was that there was a 120% baseline tariff or a $100 flat fee. Now that flat fee is remaining, but what changed was that it would rise to $200 as of June 1st from the $100. That's not going to rise, so it's going to stick at $100. So both de minimis got sandpapered down to 54%, the small package, and then the total one is 30% on items that do not qualify for that. So that's resulted in a substantial bounce in the stock market the past couple of days. I think we're up now year to date for the S&P. And want to turn it over to you, Zach. So what does this all mean for freight, as our friend Anthony Smith, economist, likes to say?
Yeah, so I think it's important to note that we have two different lines of things to really analyze and look through. One is being the supply chain impact and influence and how that's unfolding. The other being the broader economics of everything, which is a much more challenging fog to kind of see through at this point in time. We're going to largely focus on the supply chain side of things and kind of have a nod to the economics in places where we can. Like you said, Mike, I think you said it best. Like, by the time this webinar is over, we could have a totally different direction. At this time last week, we were talking about, are we going into a recession? We hadn't really seen, freight volumes really die on the vine like they had. We saw a lot of this upstream booking activity fade. That's sort of what you're looking at here in this chart that we're showing you. So I think this is probably the best place to start unpacking how this is potentially going to play out for freight. First, we're going to describe kind of what it is today, what we've been dealing with over the last couple of weeks. Really, we had about a month and a week where we paused the supply chain activity for people that are, or businesses that are very focused on Asian imports. I think there's very few businesses that don't have some sort of impact or relationship with the Asian production cycles over there or supply chains. But what we saw, last month, the 145% tariffs, which meant basically cost prohibitive. Companies can't afford to pass that along to consumers. Demand will erode. They don't want to get stuck with inventory that they can't basically pass off. They'll lose money on right away. So a lot of that manifested into what you're seeing here. And this is the IOTI for bookings from China to the United States. This is a kind of a slower indicator. We originally built this off of a 14-day moving average, which it is still today. But that means that it's also a little bit slower to ingest some of these downturns, especially in a sharp changing environment. This is typically not what we see in maritime import behavior, where we see these sharp downturns. Now, you see back in February, every year there's a sharp downturn, preceded by a pretty strong upturn. Well, that's Lunar New Year. That's a foreseen event where Chinese production basically shutters for about 2 weeks, for those of you that aren't familiar. And then we see another one in October, which is Golden Week. There's 2 major holidays every year in the Chinese production cycle, and that results in these large, a little bit of a mini pull forward and then dip. So looking at this chart here, you see that we were following somewhat seasonal trend lines up until early April, and then we start to see a dramatic deterioration there in the second half of April, and then an acceleration of that deterioration here to start the month of May. Again, this is a 14-day moving average, so that means that's about a 2-week period. The drop off here being so sharp means that things were happening pretty far in front of this and probably a lot more severely. And we do see this data in the back end. For those of you that are Container Atlas subscribers, you can see some of this raw upstream data in the bookings based on the time of booking. That's a little bit dirtier data set, though, not necessarily something that illustrates purely what's happening. But what this means for all of our domestic freight service providers is we're just now seeing this fall off manifest domestically. The freight that was dropping off in mid-April, you've got about a 15 to 20 day window transit time from China to the United States. So we were just starting to see the front edge of import volumes drop off on the West Coast ports. I iterate, the West Coast ports. We are actually seeing pretty strong volumes on the customs side of things into the Eastern Coast ports. That's still happening. That's about a 30 to 35 day transit time from Asia to the East Coast. So Houston, Savannah, New York, New Jersey, all still seeing relatively elevated levels of import behavior. So what does this mean? Well, it means that we may have enough inventory for the near term to not see inventory shortages. A lot of our business partners, shippers we talked to, they're ready for this. They knew that something like this was going to occur. Even before the tariffs, they were starting to pull forward inventory as early as June of last year because Red Sea, geopolitical tensions, the Panama Canal had a drought in 2023, et cetera. There was just a lot of disruption there. So there was already this sentiment about growing inventory levels. And now, that's not to say that we're not going to see some level of shortage or fall off. Small businesses who don't have the warehouse capacity or the leverage probably did get impacted a lot more strongly by this pause, which is effectively a pause as of today, than the larger entities. And so therefore, there's going to be probably a little bit of choppiness in everybody's experience levels and what this is manifesting to. But in aggregate, this data suggests that we haven't seen the full influence of the tariffs yet domestically in terms of inventory shortages and whatnot. We typically see average of about a month and a quarter to a month and a half is how much inventory, sales inventory, a lot of companies tend to keep on average. So that means that if they were to grow those inventories beyond that, we may not see inventories really be depleted until sometime in June or maybe even early July. That gives us a little bit of time to where we see this inventory ordering activity, which we do accept. And if you look really, really closely at this chart, IOTI China USA, which is measuring the bookings activity from 20-foot equivalent units from China to the United States, you can see that this actually hit a little bit of a level. And that's a 14-day moving average. So that means that we did see a sharp change in direction in the booking activity just yesterday. So as soon as these tariffs were announced, we've already got signs, and we see this in the far upstream booking activity as well, that companies were almost ready to hit the button and pounce on the ordering as soon as these were announced. Now, I don't know that we got clarity on exactly how that's going to work in terms of, is it ordered? Craig and I were talking about this recently about it hasn't been exactly clear how some of these tariffs are levied and kind of accounted for at the port levels or at the custom levels. There's been some confusion legally on timing because there has been so much abrupt change. A lot of times these policies take months to iron out and get, very meticulously crafted. These have been implemented in a matter of days. So there's a little bit of noise there, but bare minimum, we're already seeing the front edge of a change in ordering activity from some of these companies. So we've got this month where things are going to be a little, we probably got inventory. It's probably fine. Anybody that's operating on just in time, more heavily influenced by this than those that, like retailers tend to have upstream warehouses relatively full during this time of year. They're ready to they've already kind of prepared for this. They may not see the same level of influence as some of these manufacturers who operate on the just-in-time basis do.
Yeah, I would just add to that. I mean, the pull forward, I thought was rather dramatic. I mean, it's sort of the volume that was coming in through a lot of the ports, like Port of LA and Long Beach. I mean, a lot of those volumes were about 15% elevated relative to history, for a number of months, and something like 8, 9, 10 months. And so it seemed like a lot of the particularly the upstream inventories were pretty heavy. Flexport was talking about how the warehouse that it managed went from being about 50% full to being about 75% full. So, it was anticipated that as soon as it seemed like it was more likely that Trump was going to win the election when Biden struggled in that one debate, some shippers started pulling freight forward, as of then, and it really kind of lasted up until some of the tariffs start hitting, and now, since Liberation Day, I mean, no one wants to pay 145%, tariff, and so what we're seeing now is going to start to see what people are describing as the air pocket, sort of trendy phrase there, in late May and probably throughout June. Some of the ports are saying, like I think Port of Long Beach was saying down 35% is what their expectation is. Port of LA was saying down more like 20 or 25%. Part of that's just because the sailings have been blanked. So the ocean carriers clearly started playing games with capacity, both in terms of just canceling about a quarter of the sailings. In addition, another thing we noticed is that routing from China to Long Beach, they've slowed down the vessels pretty considerably by 3, 4, 5 days. Isn't that right, Zach? And then I guess what's being pulled up here is maritime imports coming into the port of LA. And so these are volumes that are clearing customs. And so those haven't really shown the full, drop off yet, but expect that in the coming weeks here.
There we go. Apologies.
Okay.
So I'm pulling up the TU volumes, like you said, Mike, of the ports of Los Angeles, Long Beach. They're in the white and the purple. So these are customs clearing. And you can see the last week of April is really where we started to first see the deterioration in container counts, clearing customs. And yellow, as I was retyping that's why you couldn't hear me because I had it on mute, is the Port of Savannah. And you can see the deterioration has not occurred there yet because it takes longer. We're just now at the point where a month ago, that stuff was booked over a month ago, and it's landing at the ports of Savannah and Long Beach and New York, New Jersey, probably at the same point too. So there's going to be a bit of unevenness. Now, the majority of Asian goods do come in through the ports of Los Angeles and Long Beach. And to your point, Mike, we have seen extended transit times because of the cancellations and blank sailings, as a lot of the maritime providers are, have been trying to control capacity, knowing they're going to see demand shortfalls. And it's going to create a lot of network challenges for a lot of these vessels who aren't going to have the containers to fill things up. Now, something we did notice, and I wrote about this actually in an article over the weekend, and of course it became quickly irrelevant as the tariff announcement came into play, but we had been seeing imports from China fall off as we had up here at first, but then what we haven't, what was being, we started to see this reporting where we saw these replacement countries. You see China to US over the last year, 34% down in terms of booking volume. Vietnam, Thailand, India had all kind of picked up some of that slack. But as I turn this to an absolute chart so you can see the volume we're talking about here, Vietnam is a fraction of the size of China. Although we've lost a tremendous amount of container volume out of China, we have not even come close to replacing it. I think I estimated it roughly around 7 to 10% was being replaced. And, there was basically the reports were that they were scrubbing Chinese goods going through some of these other countries. The Trump administration kind of acknowledged this. That is effectively almost neither here nor there anymore. But I think it is worth noting because of what we're talking about today. We're not going to see what we saw more than likely during COVID is the point of that. Basically where we see this sharp decline where all production is shut off. And then there's a sharp, you can see this there at the very beginning. And we're now just getting to the point where we're actually erasing the first part of COVID, which I'll go ahead and fix that now from the chart here. But you see COVID back here in March, where all imports were basically shut down. We're not close to that. We've had a little bit of a dip, and it's not even close to what we're talking about at 526, and we got all the way down to, under 200 for COVID. So it's not like we're seeing this huge removal of all production like we saw then. So I don't anticipate some massive snap like we saw then, but we should probably see, Mike, and you can elaborate here, that there's probably going to be some level of restocking that occurs, especially as we get towards the end of this, month-long inventory cycle.
Yeah, we just had a meeting before this with a very large carrier that deals with a lot of imports once they get into the United States. And what they were hearing from China was that essentially the goods that would normally be produced are still being produced. Like they haven't shut down any production lines at all. It's just what they delayed the ship dates because tariffs are based on when the goods leave. So they're just kind of stockpiling them somewhat in China, waiting for changes. And now it's a lot of the time it's okay, go ahead now that it's 30% instead of 145%. So I think we'll start to see pick up in activity. I do think it probably changes the seasonality. I mean, I think when that first round of 90-day reprieve, basically the reprieve of 90 days for every place except China to give them time to negotiate. There we started seeing pickups in both rates and volumes from places like Vietnam. I mean, now that we have the 90-day delay on Chinese tariffs, likely you'll see pickup from China for that 90 days. I mean, I guess the sort of the shipper's dilemma is that do you ship now, sort of take the 30% tariff, or do you say, well, we've seen a number of changes from what was initially proposed. All of those things were cutting the tariff rates, probably to go lower. And I think you may have a little bit of both, but I think on balance, shippers tend to be risk averse, and the bigger risk would be either that the goods don't get to the United States in time, or that somehow the 90 days ends and it goes back to those triple digit tariffs. I mean, I think that would be sort of the bigger risk, just thinking like a shipper would. Yeah, so what's X pulling up now is
I'm going to pull up the ports of Los Angeles and Long Beach. Yeah,
so this is a product in SONAR called Container Atlas. And so we're getting the data from a company that's intermediary between shippers and carriers. They deal with a lot of 3PLs. And this first chart, so right now we're sorting from China to specifically the Port of Long Beach. Now, the Port of Long Beach specifically because it's the one as a percentage of the total that's most exposed to China. I mean, it's over 60% of what of their import volume is China. And you see that sort of fall, what is it, down 40 or 50%, year over year. If you were to expand that out to year over year, 12-month basis instead of from November. So you have seen a big drop off, and that first one is using a 14-day moving average. I mean, it's even more dramatic when you look at it on a 7-day moving average, or look at it based on the date of booking, rather than the date of departure. That sort of teal line that's X showing now is based on the date of booking, which tends to be a little bit lumpier than date of departure, because date of departure is based on sailing schedule. But it's sort of noteworthy that, okay, you've had this big drop off, but we are off of the low. It's starting to improve a little bit, so it does look like there's a little bit more booking activity for Chinese imports that are headed into the U.S. But what's also interesting is this next one that Zach has now, this orange chart, the TE rejection index. And so this is an illustration of carriers managing capacity downward. And one of the most frequent questions I've gotten recently is, if there's fewer loads being booked, why are the carriers rejecting them? And it's because they're playing games with the capacity. They're managing the capacity downward. They're canceling sailings. I mean, just kind of like a commercial airline's not going to fly the plane if only a few people are booked on it. They're going to cancel it. Similar logic on the ocean.
Yeah, and these are elevated. So basically, also it's load factor on these boats. That they're trying to make sure that they're not running with quarter, half full boats as they're crossing the water. So they have to manage that capacity. Some of these Supermax ships, of course, it doesn't make economic sense if you don't have a ton of volume on them. So they're managing that capacity to make sure that it's as efficient as possible. The same thing happens in domestic transportation. You don't cut a truck in LTL unless you have a relatively full or high amount of revenue on that truck, because you can't afford to ship it at that level. But the thing that's interesting to me is that transit times, and these are published transit times, mind you, have increased up above 20 days. This is traditionally, and again, this is all of China to Long Beach. So there's a little bit of averaging here between some of these other ports, but traditionally we've talked about a 14-ish day transit time from Shanghai to 13 to 14-day transit time from Shanghai to Los Angeles. Now we're up above 20 days on this average. And that's going to mean that, and again, it's going to take a while for these boats to probably figure out how much volume is needed and how much capacity they're going to put back into the circulation. But that means that a lot of these orders, while they're, ramping back production in China, it's going to take longer for it to get here. So based on this data, if they don't change anything, which they likely will, but they're not very fast to do that. That means that if you booked and the goods were available today, which some of them are, as production probably didn't shut down entirely, they just stalled out and they were sitting in a warehouse across the ocean. If you had them booked today, that means it's going to take 20 days versus the 15 that you were used to. So it's an extra 5 days from today. So we're talking about early June on these goods at earliest for a lot of this freight that you're used to getting in a 15-day transit time. And it's going to hit around that time of year where this time last year, we actually started to see the pull forward activity really ramp up in anticipation of, various things happening politically and whatnot. But that it's going to be a relatively uneven thing as well as we get these surges of orders coming in waves. Probably doesn't fully manifest in the month of June because it's the very front edge, and kind of like what I was alluding to earlier with the West Coast versus East Coast orders, we would expect a stronger wave to hit the West Coast because that's going to be the freight that has the stronger sense of urgency on it in order to get it to where it needs to be. And then, the big question here, Mike, and I'm going to toss this to you while I go pull up this chart and get more to the land side of things. What does this do domestically to transportation that moves across the surface? So the truckload and intermodal markets have been really in this strong pull forward type environment where we see this conversion of truckload volume going into intermodal over the last year, kind of this rolling storage mentality. What do you think we see here as we see this? We're going to have a month or so where we don't really see much change, but then as inventories start to get lower and these imports start to come in, what are some of the things that we should look for?
Yeah, looking back the past couple of quarters, you've seen intermodal take share from the railroads in those sort of key corridors, particularly outbound of LA, and really that was largely due to the pre-buy reduced the need for speed, and the big disadvantage of intermodal is that it's slower. Could be truckload plus a day, plus 2 days, maybe with a little bit less certainty of when the shipment arrives at its destination. What you're seeing on the screen now is a containerized intermodal volume for the outbound United States, just outbound anywhere that originates at a U.S. point, up 1% from a year ago period. And comparing that to outbound tender volume index across all lengths of haul, down 8%. And it's even more dramatic when you just look at what's happening specifically from a port city like LA, and looking at tender volume specifically that is longer haul volume, which would be more directly competitive with that. I believe Zach's going to pull that up. And so a lot of that's just because, part of it's just because intermodal has had a very strong value proposition from the shipper's perspective, where the spread in rates between truckload and intermodal relatively wide. Last week Hub Group was talking about it being 30% on their earnings call, which is higher than you would typically think of it, maybe more like 10 to 15%. The service levels have been strong on the railroads, so that's helped. And then you sort of combine that with pull forward means the goods need to get to the consumption centers a little slower. In fact, if they're pulled forward, it's an advantage to have sort of that inventory in transit. You don't have to pay as much warehousing costs. So here you see it even more dramatic. And the LA truck market is weak. The tender rejections are less than 2%. You see the outbound tender volume from LA down 22%, and the containerized intermodal only down 1%. And it was well into positive territory, like previous weeks. And then the first quarter was up, sort of high single digits, double digits. But the question you asked is, are we going to have a reversal of that? And I think for some goods, the answer is going to be yes. I mean, some that might have moved in May are going to hit in maybe June or July, and those are going to be behind schedule, and those are going to have to be trucked, and you could see surge of trucking activity outbound of the West Coast and long haul trucking, and so you could take some share back. But it's not all going to be bad news for intermodal. I mean, you talked about how the West Coast ports likely to continue to be very favorable versus the East Coast ports in terms of import market share. Well, that helps intermodal. And also, if you see a seasonality shift where, because of this 90-day delay, there's going to be more shipments that come sooner. Instead of Christmas goods hitting the docks in September, maybe they hit in July. Well, those are shipments that have some wiggle room in terms of transit time, and it's okay if those take a few days longer than truckload. So I do think there's going to be plenty of freight for the intermodal carriers to handle. I mean, they have a lot of capacity to handle it. But I don't think that spread is going to be as wide as we've seen. So I do think the trucking is going to see more volume than it has seen.
Yeah, I agree 100%. I think last week at this time, I was talking about how intermodal was going to be disproportionately impacted by the ongoing trade war. And that's because there was going to basically be less freight in general, and everything that moved was probably going to have an elevated sense of urgency on it. So effectively last week at this time, the pull forward was over. There was no more pulling forward. It was just trying to scramble to get whatever freight you could find to make sure that you didn't run out of stuff while things were getting sorted out. Now that we have 90 days, we've now reinvented the pull forward again. Not just the pull forward, but we've also created a sense of urgency, which is going to be a net positive for truckload. I think we'll see this OTVI pop back up. Will it go all the way back to where it was this time last year? I don't think so, but it's possible that we see a pretty big return here in the summer months. I think the intermodal also gets a little bit of a boost. Now, in the coming weeks, I just showed you a chart a minute ago about customs and the ports of Los Angeles, Long Beach, both showing pretty strong deteriorations year over year. That's starting to manifest on intermodal volumes. But you see that it didn't really influence the truckload volumes. We've been kind of crawling along the floor for truckload, for almost a month now. So it's not really influencing that market as much because most of that demand has kind of bled out of the space already. So the truckload market doesn't have a lot of room to fall for the next couple of weeks, period. The intermodal market, however, out west, I think has some room to fall here for sure. And I think we'll see a little bit of a boost, a little bit extra boost to the truckload space in June that should carry into July for the most part. But then once we cross into August and we're starting to approach that 90-day period, if we don't have any clarification or any further things occur, that feels like typically we see intermodal volumes really take off in September around Labor Day. That's kind of a transition period from boat to rail. I think August may be a stronger month for rail this year than it traditionally is because all this, we're going to have a pull forward and a restocking event going on simultaneously, which probably doubles up on some of this freight volume. Now, I state that in kind of a vacuum of supply chain world. There's the economics of all this that are just really, really hard to determine because we have effectively just hit pause on economic growth for the last month and a half or so. A lot of these companies have not been investing in long-term, strategic plans. The capital investment situation has pretty much kind of just stopped. Companies are not hiring, but they're not laying anybody off. So not a lot of changing there. And we're just not really sure how that's going to manifest economically. So all this stuff we're talking about right now is kind of this next 90 days. If nothing else changes with the tariff policy, we expect this pretty high confidence that this is going to manifest the way we just laid it out. Beyond that, we've got some economic stuff that we're going to have to figure out as we go, especially around peak and holiday season purely. But I think here in July and August, we're actually looking a lot more bullish on overall demand. Our eyes have been largely on the West Coast. But, you know, as Mike was talking about earlier, and, you know, to kind of dig in deeper on the West Coast, you know, capacity, this is the tender rejection index for Los Angeles. So basically the rate at which carriers reject their shippers for, you know, capacity for their truckload volume. 1.97% is historically bottomed out. This is relatively as low as it goes. Carriers are stuck sitting on the West Coast. They don't have enough freight to pull them back east. If we looked at, you know, and I'm just going to pick on, please don't pick black here. I'm going to pick on the Atlanta market, which is actually kind of settled down here recently, but you'll see that the Atlanta market, 8% rejection rate. You know, just because we've had this softer demand side environment for trucking doesn't mean that it's happening evenly across the country. A lot of these carriers that have to position themselves out west don't have enough freight to get them back on the East Coast anymore. So it's leaving a very unbalanced domestic supply chain environment. And as I mentioned earlier, we've got Savannah and New York, New Jersey, both still seeing a lot of increased volume on the pull forward event that was happening a month ago. It takes 35 days on average to get there from China. So there's a very uneven environment right now. And I can pull up the spot rate chart on trucking. Spot rates are actually increasing the most in the southeastern region. And they're very muted on the West Coast because of this unbalanced trade policy that's going on right now. Anything to add, Mike? Or a chart you want me to pull?
Yeah, I mean, I think that's right. I mean, you have to want to keep in mind that it's, you know, we talk about LA and Long Beach. Most, there's some background noise here. LA, Long Beach really being heavily influenced by China, but these East Coast ports are too. I mean, about a quarter of New York, New Jersey is from China. Savannah, it's about 30%, and you know, Savannah market would impact that Atlanta market too. So. Yeah, a lot going on there, but it does seem like it's an uneven, you know, capacity situation when you look at some of these big freight markets across the country.
Yeah, and I think it's important for us to kind of, as we talk about some of this forward-looking situation, the freight market itself for truckload, like this time last year, we were talking about volumes starting to really pick up. And a lot of this was essentially because we were seeing an increased amount of import activity as some of these inventories were getting a little low for the shipper sentiment. You see the OTVI USA here. And a lot of this was because we had a growth coming out of Los Angeles. And then that slowly transitioned away to the intermodal side of things. So, you know, as these inventory levels start to wane a little bit, we should see something similar here where we have this, you know, wave of goods and we're coming up on seasonally strong periods of time. This June, July mountain happens nearly every single year that we pull this up. Even during COVID, before COVID, you know, 2022 here is kind of the anomaly where we were coming out of that overwhelming demand in green, but you can see that volumes bottom out in April and then start to rise up through June and July. That is absolutely going to happen now. I think before this week, we were talking about a freight market that was going to be relatively stuck in a holding pattern, but now we're probably going to see a decent tightening of this space. So you look at this chart, and I want you to remember it because it's the white line that we're looking at right here. That's this year. So our volumes are as low as they have been over the last 4 years at this point in time. So the tender rejection index, you would think, would be something similar. That's not true. So pulling up the rejection rate, we're just below, we're we're actually above where we were this time last year with 8% less demand. And the tender rejection rate right around 5.4%. So, for those of you that are heavily involved in the truckload market or the trucking market, you know that this has been a very, depressed economy for a while because there's been dramatic amounts of capacity oversupply. We were getting to the end of that cycle that started way back in 2022, just this spring. And that's why we were seeing these rejection rates. Once we cleared some of the winter weather stuff in February, they were actually staying sticky above year-over-year values. We were strongly above where we were in 2023, which was arguably the bottom of the freight market at this point in time. We had close to a 2.5% rejection rate nationally, which is the lowest we've ever seen, because there's just so much capacity. We've had 3 years now where capacity has been coming offline. I showed you an 8% rejection rate in Atlanta. Well, if we were having the same dynamics, demand side dynamics in 2022 or 2023, we're probably around a 3 or 4% rejection rate in Atlanta. That's not holding true because there's just less capacity. So if we do get a wave of demand, especially if it's a very uneven wave of demand. I mean, we've got carriers that are stranded on the West Coast right now, but after that kind of gets washed through, we could have another situation where we see another little peak, especially around the end of June and early July, like we saw last year, where rejection rates, maybe don't get above 10, 11%, like we saw in Christmas of last year for just a brief moment. But they could get high enough to cause some decent emotional responsive from the shipping community, especially as they're already dealing with a lot of these outside, factors such as tariffs and uncertainty around trade policy. And this is going to be, 3-4 months on end. And the moment that transportation capacity becomes, not as reliable, that's going to feel stronger to them than, especially after 3 years of relatively easy sourcing environments.
Yeah, I mean, you typically think of a downturn in freight as being like 12 months, maybe 18 months, but yeah, it's been a long time. It's been 3 years plus.
Yeah, and so this is going to be a weird time for transportation providers because they're coming out of a time where they have more than enough ample capacity. They've been parking trucks, brokerages, 3PLs have really been lowering rates over the last couple of years. They had a few moments here in recent months where they were able to kind of, sustain. But then after starting in about March, we saw this stalling of transportation rates, like on the contract and spot rate side, where, rates were basically just in a holding pattern because there's just so much uncertainty. And now we're going to potentially see the floodgates open again. And it could come in a pretty strong wave. So this market, the domestic transportation market, for the next month or so should be in more of the same, if not slightly down. But come mid-June, late June, July, the potential for a strong, wave, depending on how quick those boats start to come across the water. And that is the one factor I think is most important to monitor in all this, is how quick are those boats coming across the water and how many of them are there? Because this is an index. I'm going to pull up the Freightos Baltic Exchange spot rate here. This is an index we don't really expect to see sitting down here at $2,400 this time next month. With them managing capacity, as you saw Mike talk about earlier, and this is China to North America's West Coast in white that I pulled up there. And then since I can't type and talk, maybe you can talk about these rates and why we think these
the whiter of the two white lines. The higher one is the Freightos Baltic Index from China to the U.S. East Coast, which is usually about $1,000 per container higher than the rate from China to the U.S. West Coast, and that's about the spread it is currently, right around $1,000. And so, like, if you zoom out, they're still like, they've come down tremendously from recently, but still, it's if you really go back through history, they're still not what I would call depressed, but you've seen just how quickly those can move up when there are shocks. That right at the beginning of 2024, I mean, that coincided with the Red Sea situation, which started, I think, December of 2023. And then that other hump there in July of 2024, there was a lot of congestion at the port of Singapore. And so if there is a big crush of activity, you could have similar congestion at certain locations. I mean, some of those could be some of those hub cities like a Singapore again, and you can see those shoot up pretty quickly.
Yeah, I think one of the big concerns is, are we going to see this snapback of orders coming in? And I think it's going to be a little bit self-limiting because all the transportation providers have been in the process of limiting their capacity over the last month and a half. And of course, domestically, unless it's intermodal, they haven't been limiting capacity at all. Intermodal has been the only mode of transportation that has not been governing their capacity. And everybody that we've talked about here, the maritime providers have been doing this since, early last year, not to this scale that they were doing it here in the last couple of months, but certainly more so. That's going to probably help limit the downstream influence. So the ports, I don't know that we'll get the same, I don't expect 100 boats sitting outside the ports of Los Angeles and Long Beach, because they're not going to have those boats available and filled up in near enough time, quick enough for that to happen. So I don't think it's going to be necessarily as downstream congestion centric. I think it's going to be a little bit more upstream congestion centric, at least here in the near term. That could change the longer this persists. And then I would say the outlook here on the maritime side has really changed. I mean, you sort of go back a few months and it was sort of like, well, is the Red Sea situation winding down? Well, now some of the carriers are saying no, they still don't want to go through it. And then it seemed like they were building a lot of container ships that were ordered during the part on the left where everything was going crazy during COVID. But those carriers, I mean, they're pretty good about managing back, capacity. And we'll see if they, run the ships faster. I mean, it's less fuel efficient. Are they going to, stop with the blinking sailings? I mean, it's kind of, they have some levers to scale up. And yeah, I mean, it's a legitimate question if there's going to be congestion. Yeah. And again, I feel like these are probably going to be the lowest level rates we see on this index for the rest of the year. They were already bottoming out, and that's with this pause in shipping. So they really weren't influenced as largely. We saw this drop off in the early part of the year. And of course, this whole period right here was Red Sea influenced. It had nothing to do with tariffs. This inflation that we saw last year was basically managed capacity to an extent. And of course, we had an inventory pull forward starting way back here in June. I think that kind of took some of them off guard. But they happily were able to take that and then get some rate increases on top of it. Now that we've got, permission from the government to kind of order stuff again at lower costs, we'll probably see something similar, what we saw right here. I don't know if it'll be as sharp, but I think it's not outside the realm of expectation that it could be, especially since it takes a minute for these boats to kind of start stacking up again. But that being said, we've got 90 days here, and, this is, it's hard to speculate on what's going to happen next. We still don't have a solidified trade policy with all but one country, and it's with a country we had a trade surplus with, in Britain. So there's still a lot to iron out here. There's still a ton of stuff that's probably going to change. Kind of the best, you could probably think about or hope for. I think regardless, if we see some clarification with China in the next couple of weeks, or something changes there that's not 145% tariff again, what we said is probably going to stay in place. We're probably still going to see companies start to react to lower inventory levels, pull forward their freight for the coming months, especially the holidays, which most of the freight that comes in, or a lot of the freight that comes in August for peak season maritime, that's for the holidays. And since we've got this window of holiday freight, I think the infamous doll quote from Donald Trump, you're going to have $2 instead of 28. Well, I think $28 may be back on the table. And I think a lot of these companies are going to get those $28, those other $28 back into the country here in the next 90 days, if they can help it. And what I'm pulling up here, Mike, before I hand it back to you, this is the LMI, the inventory levels from the LMI. It's a survey data, anything above 50 expansion, anything below 50 contraction. Pay attention to what companies have been doing over the last year or so, or 2 years. The trend line is pretty straightforward. They've been starting to build inventories once again. So there's a month to a month and a half, like I said earlier, probably of inventory for the most part, that's going to kind of alleviate some of this panic buying or panic shortages situation. Again, it only takes 1 or 2 key items to kind of instigate some buying behavior. But for the most part, inventory should be okay for the next couple of weeks. Whether or not we get to a pure panic situation or something falls short, that's yet to be seen.
Yeah, and the inventory is getting more expensive. I mean, just had on someone who runs a company that does warehousing software. He says the construction of the warehouses has really slowed. I mean, at the same time, you're seeing the growth in the inventory levels. So yeah, expect to pay more on inventory, which helps rail intermodal on balance. That inventory in transit, take advantage of it. Take advantage of all the containers that domestic intermodal companies have invested in recent years. I mean, those are it's cost a lot less to invest in a container than a truck, and that's why I think you've seen a lot of those investments in containers. We have about 8 minutes before the hour. Should we check with Danielle to see if anyone has any questions?
Yeah, let's do that. Danielle?
Yeah, awesome. So if anyone does have any questions, there is a Q&A at the bottom of your screen. Please feel free to add any questions in there. We did get one question so far. So with 90-day tariff relief, are we going to see a rubber band effect with capacity tightening, rates increasing, and port congestion at West Coast ports affecting domestic routings?
I mean, I think we do see some level of rubber band effect. I think I talked about this earlier. Mike, do you have anything to add here?
Yeah, I think all those things are reasonable. I mean, I think it's hard to call whether there's going to be congestion or not. I do think you'll see a pickup in demand. I don't know if it's going to be the major surge and crush of containers, but making up a little bit for the air pocket that we're going to see in the next few weeks. It does not sound like the port authorities are expecting a huge surge. Gene Soroka the other day, who kind of the spokesperson for Port of LA, he says that he doesn't expect a huge surge in imports following that trade deal, and was sort of maybe he was just stressing that 30% is still high relative to historical levels, but it didn't sound like he was expecting them to be way up. And there are times when he talks about how strong the import expectations are.
Yeah, and I think we're still probably a minute away from having visibility into that, whether that's going to be true or not. I mean, based on our bookings data, we just had 1 day, and it's not going to manifest in 24 hours, probably with any strong visibility to Gene and a lot of his things that he has at his disposal. So I still think it's a little early to say that that's going to be true. I think you still have to give it a week or two to really see where some of these companies' plans are. I mean, their warehousing hasn't really been impacted yet. Their inventory levels probably okay right now. It's only going to take, we've seen this with COVID. It only takes one kind of straw to break the camel's back, and we see it kind of happen very precipitously all at once. So I don't I still think it's a little early to say that that's going to be true, but he could be right too, because we haven't seen it yet.
Awesome. Well, no other questions have come in yet. We do have a few more minutes left, so if anyone does have any questions, please feel free to post them in the Q&A.
All right. And I can point out, warehousing in this situation, like this is the warehousing price chart from the LMI. This is fascinating to me because I think before the tariff announcement, and prices never go down for warehousing. They're pretty consistent and very stable. And Dr. Zach Rogers, who I talk to pretty regularly, stated that this has been a weird time for warehousing because you see this big spike of prices going up, followed by a pretty strong downturn of them not going up as fast. But anytime you see the LMI above 70, that is a fairly statistically significant amount of expansion. And the fact that we've kind of knee-jerked around here in the last couple of months is a sign that this space is becoming increasingly volatile. And I think it's going to be a very important one to manage and watch, especially as inventory management strategies probably matter more today than they ever have.
And I guess the question there is, what's the breakdown currently between upstream inventories and downstream inventories? Because that's an important distinction that Zach Rogers makes.
Yeah, the upstream, he's never seen this level of divergence between upstream and downstream. Upstream
would be like in the Inland Empire and those places, and downstream would be near consumption centers?
Exactly. So you're talking about downstream is going to be the retailers, the fulfillment centers, the consumer products. Upstream is going to be the manufacturing, the wholesalers that sit up there and, obviously on the West Coast, but they have not been able to grow inventories in the upstream manufacturing sector as much, whereas the downstream, the retailers have been able to kind of keep that whole, if you will, for the most part. So the thing that the tariff policy was supposed to really do was, really inject energy into the upstream and the manufacturing domestically, when it's actually done the exact opposite, because, it takes time to build out all these processes, and manufacturing components don't get just replaced overnight. So in the near term, it's actually hurt that sector because domestic manufacturing relies on all these components that we import from places like China and other countries, and they're getting cut off effectively. And so they're the ones we're probably going to see a little bit of a nice bounce back in the coming months.
So we did receive one more question. Can you elaborate a bit more on how much imports from Southeast Asian countries will replace China?
Yeah, so and I did write this article last week, which again, outdated now, but I estimated around 7 to 10% of the goods from China had been replaced by Vietnam and Thailand and India. And that's just those three. There's probably a few others in there that replaced a little bit as well, but it's certainly not enough to plug that, the enormous hole that's left by the lack of Chinese production here over the last month. But it should buffer it to an extent.
Yeah, I think over the last several years, we've seen those Southeast Asian countries grow in terms of import volumes at a faster rate than imports from China. We could probably support that with some graphs there. But would say that, a lot of the shippers, are using kind of a China plus one strategy. They don't want their entire supply chain to be just dominated by China, because you just run the risk that there's some major event that just kind of cuts us off from China. It could be tariffs, it could be invasion of Taiwan, it could be just more focus on human rights abuses and those things. But so I think there's been some risk mitigation where companies are going to these other Southeast Asian countries. I would also mention one of the more interesting conversations I've had with SONAR. A customer was a company that made certain consumer product, a startup company, and they looked at manufacturing in China, and they also looked at manufacturing in Vietnam, and they got back samples, and their conclusion was that China was cheaper, but Vietnam was a higher quality product, a more consistent product, and they went with Vietnam because they wanted to just protect the brand. So thought that was interesting too.
Yeah. And to just close, because we're right at time now, this is going to take time to manifest. Like today is, we're probably not going to see a ton of change here in the next week or two. This is going to take time to kind of play out over the next 6 weeks or so. Cool. All right. Danielle, you want to take us home?
Yes. So if you have any other questions, please feel free to reach out to cs@gosonar.com. And since you registered for this webinar, you should receive a recording of it sometime tomorrow. And so feel free to share that out with your teams. And thank you for joining.
Okay. Thanks for dialing in.